Mark, August was a very difficult month for most asset classes. European equities were no exception. The Artemis European Opportunities Fund outperformed its index, but it still posted negative returns. Can you walk us through that performance for the month?
Yes, and I suppose it's never a great position for a fund manager to say he's outperformed a falling market, but yes, some big macro headwinds prompted by the devaluation of the Chinese currency. We did quite well. We, as I'm sure viewers know, we look very much for visibility in the earnings that 3 to 5 years of visibility, and that's led us away from some sectors such as basic material, oil, sensitive stocks as well. And actually we have no overweight in healthcare as well. So there's just the way in which we do things at a micro level.
So does that mean you've managed your exposure to China in any way, or by this sector allocation that you just described, you were pretty much defensive towards the theme of China?
It does, and that it's sometimes nice. It's nice in the way in which we do business that sometimes you find that stock selection and it sort of results in a macro tailwind for you, and that's certainly the case. We've got no direct exposure to China. You can't avoid. I mean, China has an effect across the board. So, there are always effects on the portfolio, but the direct exposure, things like the auto parts. It's not because I don't like BMW per se. We struggle with the visibility. When you look at that company, it makes arguably 50% of its profits in China. And I don't have a crystal ball, but I just don't know, and I don't have any confidence in what those profits will be going forwards, and the market.
They become risky.
They've always been risky, and I don't have any visibility, which just means we haven't invested in the autos companies, and now that's working very nicely for us. Same with some of the big luxury goods names as well, and basic materials. Again, do I have any great insight into the oil price? Obviously not, but it does lead us away from that type of sector.
Have you actually taken the opportunity to increase holdings in these sectors, particularly energy and basic materials?
No, I don't suddenly have any confidence there, and I think they'd have to fall to very low levels for us to. The risk reward has got to stack up in a major way in those areas. A while ago we did actually buy. I think I talked about it before, but TGS Nopec, which is a seismic survey.
Norwegian oil companies, isn't it?
And it's very. It's done well when oil prices have been low before, and it's very asset light. So it was a while ago, and it's been a bumpy ride. I mean, you can't get away from the fact that even the best name in the sector is going to be bounced around by what the oil price is doing.
So markets falling to the tune of 5% in Europe for the month. Clearly, this brings up some opportunities. Have you been adding to any specific holdings during the month?
Yeah, I mean, what happens is you get people get fear, they throw the baby out with the bathwater. So you get some names which come back onto our radar. They tend to be growth names, sort of say missed on our quarterly earnings. Geberit is one that springs to mind, which is actually quite European. Geberit
Geberit, the Swiss company, what do they do?
It's effectively the plumbing behind. They call it the plumbing behind the walls in toilet facilities where you'll see the name as you go around Europe, but actually the name is written in sort of fancy writing on the front, but it's what goes on behind the scenes. It is still quite European, but they missed out. They've missed out slightly on a quarter. We don't think there's any reason to change the numbers for the long term. It's a superbly run company. They tie in when you're fitting these systems, the engineers they have training schools, and the builders get very used to fitting Geberit systems, which are easy to fit. So good margins, good growth.
Good story. You've also added to a Nordic insurer, Storebrand. What attracted you to them?
Yeah, Storebrand is a much more of a self-help name, and we met the management last quarter. That's a company with it's got a big back book of legacy business in the defined benefit. You're all familiar with this argument, the defined benefit schemes. That is what they're doing is trying to run. They're effectively running that, trying to convert that business into paid up policies. So they're trying to run that business off, if you like. But that actually sucks in in the short term. That sucks in capital, because if you have a paid up policy, the regulator requires you to park capital behind it. So their returns don't look great at the moment. But as they transition that business into much more what I would call a traditional sort of asset gathering to a unit trust type business, which is defined contribution, where actually they just take a fee. They don't have any risk on their book because the client then takes the risk. It's actually much better use of capital. The return on that capital goes up, and over quite a long time frame, which is what we like. That company, I think, will look remarkably cheap versus its price to book as it stands now. So that's it's very much a self-help name, though.
Well, we'll be looking at it. Mark, thank you very much. Nice talking to you.
Thank you.